welcome to the deep dive. You gave us a pretty big task. Cut through all the noise, the spreadsheets from the recent Starbucks Q4 2025 earnings call.
Yeah.
So today, we're diving deep, really focusing on the strategic core of that call, the opening remarks from the CEO, Brian Niccol.
Right, and our mission here is pretty sharp, actually. We need to really get our heads around this strategic roadmap, the Back to Starbucks plan. That launched about a year ago, right? The idea was getting back to that foundation of exceptional craft, connection, and welcoming coffee houses. So yeah, this isn't just a quick look at the financials. It's more of an analysis of the evidence. We're pulling out the concrete data points that, suggest this turnaround is actually taking hold, looking at where those big investments in fiscal 25 went, and importantly, how they're setting things up for FY 2026.
Okay, let's unpack that then, starting with the headline results. Because, anyone watching this stock saw the big news was that the company finally seemed to stop that long slide.
Yeah.
What was the absolute top-line metric the CEO used to say, hey, the strategy's actually working?
Yeah, the biggest one, the one that probably generated the most confidence, was hitting that 5% global revenue growth for the full fiscal year. But the critical number, the operational proof point, was that Q4 global comparable store sales growth. It was 1%.
1%.
Now, I know, that sounds small, but here's the strategic significance. That 1%, it marks the first positive quarter for global comps in 7 quarters. So it's maybe less about massive growth right now and more about reversing what was becoming a really deeply entrenched negative trend.
That's powerful context. First positive quarter in almost 2 years, basically. But let's be real for a second. 1%. It feels like it's just barely stopping the bleeding, right?
Yeah.
How do we know this isn't just like price increases hiding the fact that people still aren't coming in as much?
That is the crucial question, absolutely. And the CEO specifically tackled that by focusing on operational proof points, particularly in the U.S., which, let's face it, has been the biggest headache. The U.S. business didn't, shoot the lights out, but North America company-operated comps improved to flat year over year.
Got it.
And flat is actually a victory here because it means they stabilized the decline. And the critical detail, the thing that proves they weren't just leaning on price, transaction volume.
Okay, tell us more about the transaction volume, because that's the real pulse, isn't it? The true sign of customer demand.
Exactly. So transaction comps improved sequentially from Q3. And just for clarity, transaction comps simply compares the number of individual sales to the same time last year. So yeah, more people were actually coming through the door or ordering. What's really interesting here is that the percentage of coffee houses with positive transaction comps, it more than tripled from a year ago.
Wow, tripled.
Yeah. So it wasn't just a few star performers carrying the weight. The momentum was kind of spreading out more broadly.
More than tripling the number of stores actually seeing more customers walk in.
Yeah.
That really does sound like operational healing, but like at scale. And it seems like they're getting back the most important part of the day, too, that morning rush.
Absolutely. They specifically noted that flat morning daypart transactions actually outpaced the overall recovery. Dayparts are just, chunks of the day. And winning the morning that absolutely essential coffee run, it shows they're getting back to those core customer habits. And this momentum, it built up so much that U.S. company-operated sales comps actually turned positive in September and then stayed positive right through October. And that was driven specifically by those transaction gains. The engine is definitely catching.
Okay, so while the U.S. was stabilizing, international sounds like it just kept being its reliable self.
It did, yeah. It provided that necessary ballast, you could say. The international segment delivered 3% comp sales growth in Q4, and this was led by some really incredible strength across key markets.
Yeah.
Japan bounced back into positive territory, which was great to see, and strong growth also in China, the UK, and Mexico.
Speaking of performance, the earnings per share, the EPS, came in at 52 cents. That feels, relatively low compared to some past results. How did the CEO frame that number?
He was pretty transparent about it, actually. He said, look, that EPS reflects the substantial investments they're making right now. They're pouring money into labor, into tech, into fixing up the stores. The strategic message seems really clear. They expect to, and I think the quote was, grow the top line first, and then earnings will follow. It's an investment for multi-year growth, which, means short-term profitability takes a bit of a hit.
That sets us up perfectly for Pillar 1 then, the operational core. If profits are taking a hit because of these investments, which ones, specifically in customer service and speed, does the CEO think are the most crucial?
Well, it really starts with the people and the experience. They scaled up what they call the Green Apron Service Standard. That's their new kind of mandate for how the customer experience should feel. And that went live across the entire U.S. company-operated portfolio back in August. The investment was literal. More staff, more hours, putting more partners, baristas, on the floor at the right times to handle the flow.
Right. And the practical result of putting more money into labor, what did that look like?
It seems to be twofold: accessibility and engagement. First, they reassessed and extended operating hours for about half of the U.S. stores. So nearly all of them are now open consistently at or before 5 a.m. That's critical for grabbing that morning traffic we were just talking about.
Makes sense.
But the internal result, that's maybe the real strategic win here. These changes apparently resulted in strong partner engagement, and this is huge. Record low hourly partner turnover.
Record low turnover. Okay, that explains the lower EPS perfectly, doesn't it? They're essentially sacrificing some short-term profit to stabilize their workforce, which should, down the road, lead to better, faster service and presumably lower training costs too.
Precisely. That cost of investment is buying them stability and hopefully expertise. And then technology comes in to support that newfound stability through improved throughput.
Okay, tell us about this smart queue sequencing algorithm. That sounds a bit like, corporate jargon designed to maybe confuse the average listener.
It does sound complex, yeah, but you can think of it like digital air traffic control, but for coffee orders. It's designed to dynamically balance all the different order types, mobile, drive-through, cafe, to stop those bottlenecks from forming and make sure the baristas aren't totally overwhelmed by competing demands. And apparently, it worked. Over 80% of U.S. company-operated coffee houses had cafe service times averaging 4 minutes or less.
4 minutes or less in the cafe, that's a huge step, especially towards solving that speed issue that really plagued them during those peak mobile order times we all remember.
It is, yeah. Though the CEO did note that drive-through times are still below that 4-minute target, so still some work to do there, clearly. However, one channel that is booming is delivery. U.S. delivery grew nearly 30% year over year in Q4.
30%.
Yeah, and it surpassed $1 billion in sales for the full fiscal year. Huge growth there.
They also mentioned simplifying things on the back end, too, with the Clover Vertica brewer.
Yes, that's actually pretty key. The Clover Vertica, it simplifies the whole process for baristas to offer a, genuinely freshly brewed cup of coffee, whatever the customer chooses, moving away from those big, complex batch brews. That small operational tweak saves time, improves the product quality, and kind of fulfills that promise of exceptional craft.
Okay, so Pillar 1 was all about stabilizing the workforce, boosting speed through people in tech. But, speed only matters if the customer actually wants to, sit down and maybe stay for a minute. Which transitions us neatly to Pillar 2, the physical experience, optimizing the actual real estate.
Yeah, and the CEO was surprisingly candid about the state of their physical stores. They basically admitted that some locations just didn't have a viable path to profitability or, frankly, weren't creating that warm, welcoming, third-place vibe. You can't really talk about connection if the store feels, sterile or just run down.
Right. So they had to start by sort of trimming the fat, I guess. What was the result of that internal review?
Well, the result was what you might call a disciplined retreat. North America company-operated store counts actually declined by about 1% on a net basis in fiscal 25, which shows a certain strategic maturity, right? Sometimes the best way to grow is actually closing the doors on units that are just draining time and resources.
So how does a growth strategy look going forward then? Are they just closing stores or are they focused on building better ones?
They're definitely focused on building better ones, and with optimized economics, they're piloting a new coffee house prototype. It's designed with a lower build cost and smarter, more optimized space use, but still trying to keep that full coffee house feel. They even gave an example of converting a pickup-only spot in New York into one of these small format prototypes, really testing out those improved economics.
And what about fixing up the existing stores? The ones that aren't necessarily closing but maybe aren't great?
That's the Uplift renovation program. This is all about bringing back the warmth, the texture, the seating. It's like physically reversing years of prioritizing efficiency, maybe, over atmosphere. They finished nearly 70 of these uplifts in Q4, mostly in those really high-traffic, critical markets like New York and the Southern California.
Okay, 70 is good, but it doesn't exactly move the needle on a global scale, does it? What's the bigger goal there?
The ambition is pretty huge, actually. They plan to complete more than 1,000 uplifts by the end of fiscal 2026.
1,000, wow.
Yeah. Scaling a renovation program like that is incredibly difficult, logistics-wise. But the early data they have from those first 70 stores, it shows encouraging bumps in sales and transactions. So the strategy seems validated. Better environments really do lead to more customers sticking around.
Okay, let's jump to the third pillar, culture, menu innovation, and crucially, value perception. What did the overhaul of their marketing and menu deliver in terms of, say, attracting new kinds of customers?
Well, it seemed to immediately accelerate their brand health metrics. The launch of new items, specifically things like the protein cold foam and protein lattes right at the end of September, that was deliberately marketed as being incremental. Meaning it brings a different kind of customer into the store, maybe more health-focused, expanding the demographic beyond just the usual loyalists.
What's fascinating there is the brand health metrics. Those can often feel a bit, squishy.
Yeah.
But the CEO actually provided some concrete numbers.
He did, yeah. Brand affinity, basically. How much customers actually like the brand accelerated in the quarter. It reached its highest point since 2023. And maybe even more impressively, Starbucks ranking as the customer's first choice for coffee hit a 5-year record high. So this turnaround effort, it seems to be clearly landing with consumers.
And the fact that this isn't just their rewards members spending more money, that feels like a huge operational win, right?
It's probably the ultimate validation, isn't it? Non-Starbucks Rewards customer transactions grew year over year for the second consecutive quarter and across all times of day. That shows the appeal is genuinely broadening out, which is absolutely critical for long-term health.
So how did they manage to redefine value across different generations without just slashing prices everywhere?
Well, they argued that value isn't just about the price tag, it's the whole experience. They consciously tried to strengthen that value perception by investing in that green apron service we talked about, better interactions. They brought back the condiment bar, which is a small thing, but maybe a psychological nod to customer comfort and control. And they simplified the pricing structure, including, notably, removing the extra charge for non-dairy milks.
Ah, yeah, that was a big one.
Huge. So these are all non-pricing levers that are designed to improve the perception of value and fairness. The core message seems to be a great experience plus a handcrafted beverage is the value proposition.
Okay, before we look ahead fully to FY 2026, let's just quickly touch on the global engine again. International delivered record revenues, right? $2.1 billion in Q4, $7.8 billion for the year.
Yeah, it just underscores their global maturity, doesn't it? They opened 316 net new coffee houses just in Q4, totaling over 900 new stores in all of FY 2025. And they're using these really specific brand building investments, like that new flagship store inside the legendary Santiago Bernabeu Stadium in Madrid. Things like that really enhance the brand's premium image internationally.
Yeah, and China, the market everyone watches so nervously, delivered its second straight quarter of positive comp growth at 2%.
Yes, and the CEO sounded, pretty confident about long-term growth there. They mentioned strong interest from potential partners in the China region, and their plan is to retain a meaningful stake. It shows they're definitely not pulling back from their biggest international market.
Okay, so with that foundation laid, what does it all mean for fiscal 2026? What's the core intent, the main goal going into this new year?
The stated goal is, well, pretty aspirational, to become the world's best customer service company. Operationally, a key part of that is scaling the assistant store manager role, which adds more focused management right there on the floor. But maybe the most radical change, the one that really jumps out, is the dramatic simplification of store-level reporting.
Okay, this is the part of the deep dive that I think requires the most focus from us. They're taking, nearly 24 metrics they use to track, down to a scorecard of just 5 key performance indicators, KPIs. Why is that such a massive strategic shift?
It really seems to be about clarity and focus. I mean, the thinking goes, when you overload managers with dozens of metrics, they end up optimizing for none of them effectively.
Right.
By narrowing that focus so drastically, the CEO is basically ensuring every single store manager knows precisely what the company cares about most. And those 5 KPIs are the customer experience, the partner experience, transactions, inventory availability, and food safety. That's it.
That is a fascinating distillation. You're basically focusing the manager's entire brain on frontline execution, right?
Right.
Making sure the product's there and safe, the server is great. That leaves very little room, presumably, for them to worry about balancing complex labor costs or, running local marketing experiments at the store level.
That's exactly the trade-off, I think. It feels like an explicit choice to simplify the daily grind for the store leader so they can pour all their energy into the quality of the coffeehouse experience itself. The bet is that the sophisticated tech, like that sequencing algorithm and the new staffing models, will handle the rest of the complexity.
And finally, what about menu innovation for 2026? Anything specific mentioned there?
Yeah, a couple of things. They plan to introduce an up-leveled bake case featuring new, more artisanal bakery items, and they're going to keep optimizing and up-leveling the matcha menu, apparently. But the really immediate focus, the thing they seem most excited about, is the upcoming holiday season. The CEO expressed really strong confidence that this holiday season will be iconic. And the reason is, for the first time, all the different parts of this turnaround plan, the staffing, the smart Q tech, the welcoming uplifted stores, and those menu classics like the returning eggnog latte,
Yeah.
they're all supposed to come together simultaneously.
Right. The foundation's laid, the investments are flowing, and the CEO sounds confident the momentum is building.
Hmm.
All validated, as you said, by that first positive global comp quarter in 7 quarters.
That's the perfect synthesis, I think. The CEO basically summarized it himself. We set a plan, we're working the plan, and the plan is working. It's a comprehensive approach, isn't it? It addresses the cafe experience, the tech, the real estate, the menu, all at once. It's holistic. It acknowledges that fixing the business needs more than just, better marketing slogans.
A very comprehensive and detailed roadmap indeed. Thank you for walking us through that whole strategic vision.
My pleasure. It was interesting to unpack.
And for you, the listener, our learner, we leave you with this final provocative thought based on this deep dive. The CEO outlined this multi-year strategy, heavily focused on simplifying success down to just those 5 core KPIs for store leaders, customer partner transactions, inventory, and food safety. How might this kind of radical simplification actually influence day-to-day decisions right there on the ground? And maybe more importantly, what potential unintended consequences might pop up when you narrow focus so intensely onto just those 5 areas? Something to chew on until our next deep dive.